Okay, we are starting.
Okay.
All right, Manish, all yours. You can start.
Okay, yeah. So thanks a lot, everybody, for coming for this topic. And yeah, good morning. And originally we were scheduled to do on renewable energy, and but we thought that it is better to do on this topic because it is like more appropriate, and the best time for learning is when basically it is tough time. The tough time is the best time, is very productive if you want to learn something. And so it is the people who are invested in US market, either through
Manisha,
ETFs
if you
or
don't mind,
directly. Yeah.
Manisha, if you don't mind, there is an option called a slideshow. You can click the slideshow; it will be clearly to view the screen.
Okay. In the share,
You can see that at the bottom there is a monitor, right?
this one.
That one.
Oh,
And this one,
okay.
yes.
Okay.
Thank you.
Yeah. So yeah, so this is the topic. Okay. And this is more like a discussion. You can say that because like I also am learning together with you guys, and like we will talk like what happened, and basically what my learning is, and then what we can do. So if you look at this is our agenda. um, so we'll see what, like, the first is sequence of events, then were there any signs, were there any big indicators, and has this happened before, and but where are we now? Okay, where are we now? And relating the key factors, and what do we do now? So these are the few things we'll cover. And every time basically I have a lot of content, and we promise that we will not exceed 1 hour, but it happens that we go more than that, and it becomes a very long meeting. So I try to contain my content as much as possible, so that we can discuss more. Okay. uh, so let's get into it. So what happened in this cycle is, like, this is the events, how they unfolded in last 2 years. So in January 2020, the US market was running normal, and then COVID-19 happened, and then obviously because there was so much uncertainty, that it brought a very sharp crash. It right it was There was a sharp crash, and then the indices were falling like 5%, 10% was like quite normal in the month of March. But in between there were like 5% up days also. But it was probably the sharpest 2 weeks crash um, we we have ever seen, because, and that was quite justified too, because nobody knew what will happen due to COVID. If I remember correctly, that there were basically forecast that there are like 50 million, for US it was like there would be more than 50 million people infected, and there would be more than 15 million death. That is like if those kind of forecast is coming, then of course the stock market will adjust, right? So so and at the same time, when people have to sit home, then the government has to do something. A lot of people who are working in hospitality industry, cruise and airlines, etc., lost their job. So the government basically what they did, that first they dropped the interest rate near zero, and that was not sufficient. Then they start a lot of free money, like a lot of money was injected into the economy. And the economy was already on steroids. The interest rate was not very high in US even before, even in 2020 they were not very high. On top of it, like even like they, let's say they were at 1.5%, and we drop it to almost zero. So that is like significant drop from there. And then after that, you send checks to home. A lot of people are getting the free money while they are sitting home. So then what happened, then a lot of people thought, oh, we are just sitting home, why don't we just use Robinhood and start trading, learn a stock market. And then the stock market start reverted here, and then the stock market just kept going up. And by June, July, August, you saw a lot of SPACs coming in. Like I did not know what is a SPACs actually, but then I heard, oh, it is zero, what is that called, uh, blank check companies. I really uh, was amazed that how can I give money to somebody without thinking that what he will do with it. Right? And there were like almost 1,000 plus SPACs launched in that year. Like I have seen my list of more than 600 SPACs somewhere in December or January of 2020. That is how crazy it has started becoming, like meme stock, the stock like people discuss on this people discuss on Reddit or some website, and they gang up, and basically they are ganging up against hedge funds and bringing some hedge fund down. A stock like GameStop was $5, and from $5 to in like 2 days or 3 days become $500. And a lot of people thought that is okay, it's not a problem. Right? So and valuation were history. So interesting thing has started happening here, that if you talk to somebody like okay, like the stock is being traded at historical valuations, something which like even the sales is not even 1 billion, but the company is trading at 50 billion. And then you are saying, oh, this is like a crazy valuation and this company still doesn't make money. Then people will say, okay, yeah, this company doesn't make money, but they may have some cash flow, and then this is future growth, and it still is a great buy. And then and then you will on side, you will give them a company in the same sector which is making money, it is cash flow positive, it is profit positive. And then they'll say, no, that is not a growth company. And then you'll say, okay, why it is not a growth company? They'll say, well, because it is earning positive. So like earning positive, like if some company is making profit, was a taboo. So companies like which are growing decent, like let's say 5-10% and making a lot of money, giving a lot of dividend, they were sent for a skywalk. Nobody wants to touch them. Berkshire Hathaway doesn't give dividend, but it is quite significant growth they give. Then Philip Morris, 3M, or Dow Chemicals, or Chevron, like all these companies, nobody wants to touch them. So that is a like classic kind of like that was unique to this one, where the valuation were totally ignored. And inflation, then what happened, so much money was coming, and then the market economy was already on a stimulus from 2009. And now the stimulus became very big, like they I think they put like 13 trillion in the economy in COVID time. So if you put this much money, then this is bound, like this is bound to happen, like because a lot of money chasing the commodity, the amount of commodity is fixed. So if the commodity is fixed, then there is a lot of money, then people will forcefully buy the things. So most of the people they started buying houses, some people started buying cars, some people started doing something else. So that basically creates inflation, because all these things create demand. And when they create demand and then the supply is, let's say, limited, then then you get inflation. And surprisingly, the inflation numbers started coming up somewhere in June, July last year. And in December, they were already to the level where they are now. It was 7.6 or 7.9 in December of 2020. Still, the interest rate did not reduce, money supply was not reduced. And now what happened by the month of December, January, market started getting nervous because they thought that Fed is very much behind the curve. And if they basically they will have to increase the interest rate significantly if they don't do it now, or the inflation will be so rampant that it will kill the economy. So that worry basically peaked the market. So no action done by Fed, but the market was basically cognizant, and basically they started adjusting themselves. Then you can see the Facebook earning was the first accident. Then the Fed, as soon as the Facebook earning came, the Facebook stock tank, and then and I don't think that was like whatever happened in the Facebook earning, that was so much like was like something like it was such a big surprise. It was so big surprise that it can wipe out like few $100 billion. No, because there was so much froth in the market. Market was looking for exit doors. That's it. So a lot of money exited from there, and then it started bringing down the market. Then Fed also indicated that they will start taking out like $490 billion a month from the market, and they will increase the interest rate. So Fed did not increase the interest rate yet. They increase only, I think, 25 basis point, but they hinted that they will increase to 50, and even then, like, market started dropping. And then Netflix earning second accident. Then what happened, that all these smart money, which is like hedge funds and ETFs fund, like innovative ETFs, all these funds started pulling out. And once they start pulling out, they are very like illogical. When they put out, they just put their machines to work. Okay, just trade whatever money you get. So for last 2 weeks, except for this Friday, the market was just like not giving even a small relief. So bad. It was very bad actually. And now we are almost in bear market from S&P and Dow, and Nasdaq is clearly in bear market, more than 20% down. So that is where we are right now. And a smart money is still blowing out like this. There are a lot of hedge funds getting bankrupt. And once they are getting bankrupt, or they are about to get bankrupt, they exit at any cost. And that is what puts pressure on the markets. Okay. So were there signs? Yes, there were early signs. If you look at it, a lot of people say that, oh, okay, so PE is a history. Nobody should look at it. This is something. But today, they are not only looking at the PE, they are looking at every parameters. So anybody who is having very high PE, they just don't want to touch. You see, GameStop's, you're seeing his company increase in value in overnight. Price target for Tesla, 15,000 per share, right? You see the retail trading activity. You see this is 2019 and 20, and you see just in April 2020 how much it jumped. So look at the activity. Retail volumes per day used to be 0.5 billion. 0.5 billion was the normal, 0.5, 0.6 billion, and they reached like 3 billion. So that is what? So how many times? 5 times activity increase. 5-time activity increase in retail. So this is generally, activity increase is a good sign, but like it is very abnormal level. And because it is retail, that is this is clearly the peak of euphoria in my view, right? So these were the signs already there visible. Yeah, and now you look at like in terms of some pointers, you can see that the valuation were totally ignored. Many stocks were selling at 50 to 100x of sales. So many IPOs were launched successfully at lofty valuations, like crazy valuation. Like Robinhood kind of company came at 38 billion or 40 billion at IPO itself, and the company has history of only 2 years, and they don't make money, but they gain market share very quickly. That was the only thing they told to the market, and market gave them like, oh, okay, 40 billion is good for you. And now they are at 8 billion. So, and the Rivian auto company, if you see like that auto that IPO came at 200 billion. How much it takes to create a like 200 billion kind of company? Like some company took 100 years to reach 200 billion, right? And this Rivian auto is not a tech company. Actually, it is a car company, which is like basically automaker with I think EV kind of trucks or self-driving. It is not really a tech company which can say they can scale overnight. They cannot scale overnight. So why somebody gave them that kind of valuation? Blank check companies, SPACs, thousands were launched, and thousands were successfully. Like people were like listening to Chamat every day. ARK, ARKK, and meme stock were rocking. So ARKK is ARK investment, I think. This is this is the innovation fund, and they are ETF. So that means all the companies where they put money on, once they put the money, then you can watch the stock, what a stock is doing. Growth was only thing to buy. The company with positive earnings were considered value companies, and nobody wanted to buy value companies. Value companies were history. Challengers were priced much higher than market leaders. So this is a clear indication that in any sector, if you go and then you see market leader is at, let's say 20p or 30p, but the challenger is like at 100p, and then you adjust the P ratio for the growth. So you look at the PEG ratio, but even at the PEG ratio, the challengers and in a lot of companies were basically at higher valuation than the market leader, like Amazon and Shopify. If you see, the Shopify is in similar sector and is challenger. Amazon is a market leader, let's say. And Amazon is also growing, Shopify also growing. So you see the growth adjusted PE, Shopify was at very high valuation. So what happens that when in any race, a lead the market leader has higher chance to win than challenger. But challengers are most of the time, like this change happens, the challenger wins, but there are like 6 7 maybe 6 challengers, 10 challengers. Out of that, one challenger wins, right? And slowly big companies come down, new challenger comes in. But out of these 10, which challenger will win, we do not know. So that is why the challengers should be priced much lower, and the startup should be priced even lower. And but in this last 3 years, it was totally amazing to me that the market leader was priced cheap, and then challenger was priced even higher, and startups were even higher. And some of these startups, nobody will know that they are growing, because for a couple of years, if they are not showing any growth, then how to know that they are growing? So they should come very, very cheap. Like nobody should be giving them a lot of money unless they are showing something. So that gives an environment to basically nurture a lot of fraud companies. Okay. And Warren Buffett became a laughing stock. There are a lot of experts who were laughing at Warren Buffett. He has gone old and he doesn't understand the valuation anymore, and this thing and that thing. So these are all signs of like something is not correct in the market and there is euphoria going on. If you look at the big indicators, if you see this one, so this one, if you see so this movie is like we are watching it again because this already happened in 1999 and 2000. And we look at this is tech, media and telecom market cap share in S&P 500 companies. So it was at 36 point, I think it reached almost 40. And that was almost the level when it was .com, and then it started turning around. So as the companies in S&P 500 companies like this tech became very big, and you see that like after that they start coming down. So is 1999 it took a lot of years to reach there, right? So this indicator is one. Then another indicator, this indicator I was aware, and that it is market is almost as 2 times of market cap to GDP for US, had already reached almost 2 times. So that is why I was very careful in US market, and this indicator saved me a lot. um, so if you see that market cap to GDP, like earlier it used to be like less than market cap, less than 100. And when this .com happened, it was 1.5. And after that, this was like lower for so many years. And only in 2013-14, it reached 1.5. And after that, it reached almost 200. So ideally, when it reached around here, that is already a warning sign. But look at it, already happened before 2020. So when in 2020, a lot of stimulus was coming here, that whole COVID cycle, we were already in problematic zone, right? So we were already in a territory where it is a very bloated market. And then you see these kind of news like 4.5 trillion in the sidelines to be put to money to put. So now if you are already in this territory and you have 4.5 trillion waiting, then what will happen? It will just go jump here. Then you see this Rivian, the stock source, like it already was at very lofty valuation, and then when the IPO came, then this stock rocketed, and it became $200 billion company. People were so happy that they were just like the making money in a stock market was so easy that people were just waiting waiting for Monday to happen. And now today people are waiting for market to close. So all these were the signs which basically tell people that okay, probably it is time to be careful. Now if you see this, so this is how some of the big, very much talked about stocks in this market. But has it happened before? Yes, it has happened before. So in .com bubble, similar thing was there. The bubble was built, but yeah, I think cycle is similar, but the things were much slower than today. So from 95 to 99, the bubble was built. So in our case, the bubble started building like from COVID crash. You have to take because that is where the bottom of the bull market would be considered. So so that is quite fast. Like it is current one is 1.5 year, and then these guys took 4 years. Valuation of all Nasdaq's company reached 7.6 trillion on peak. Total sales only 0.2. You look at this. So what we are talking about, it is roughly what 35, 36. yeah, roughly 36 x on sales. All these IT companies, these were .com companies. So their total sales combined was only 200 billion, but they were traded at 7.6 trillion. Many companies were selling at 500x on sales, right? Any price for .com companies. Like if you just say .com, yeah, people are ready to pay you any money. After the burst of the bubble, the index dropped almost 80%. It took more than a decade to reach back. So I think what peak was more than 5,000 on Nasdaq, and Nasdaq crossed that peak again somewhere in 2015 or 16. Amazon, Yahoo type companies also, which were very much genuine companies, and they were really doing good business. They were market leader, like for the website and search engine. Yahoo was a market leader at that time, and they dropped more than 90%. There were very few survivors from the bubble. Most of the companies were either finished, sold out, or merged. Like I was looking at the list of survivors, like there are only 5 or 6 survivors which are surviving on their own. And a lot of products are still around, but they are not with them. Like PayPal is still around, but it was, I think, with eBay, and then now it is independent, and then there are some products were brought by other companies. The companies were merged with other companies at very low valuation. You have to understand that Microsoft kind of company, the sales of Microsoft at that time was 10 billion, and Microsoft market cap was 600 billion. So it was 60 times sales it was selling. Microsoft, so expensive. Like Bill Gates were like, oh, like the biggest hero in the world at that time, because he was the richest man. And then it took 16 years for Microsoft to recover and reach that price. Yeah. So that already happened in .com, and I think that this tech bubble sounds like very similar to .com. The reason I'm saying similar, because a lot of companies, let's say like Berkshire Hathaway, 3M, Dow Chemicals, or or any company which was consistent, Philip Morris, they did not drop a lot. They did not go up a lot. They are not dropping a lot. So it was basically mainly a lot of tech stock, a lot of innovation stocks. That is where the bubble happened this time. But this bubble is many times bigger, because now, so it was 7.6 trillion in whole Nasdaq, but now Nasdaq is almost at, I think, 50 trillion or so. It is significant money in Nasdaq. So even if they drop like 30-40%, it is very big money there, right? So you look at these names: Upstart, Peloton, T-Dog, Rivian, Roblox, Roku, Shop, Coin, Sophie. So Sophie is, I think, a Spotify or Shopify. Shopify is this. So Sophie, what is the, yeah, Sophie. Yeah, I do not know what this company very well. Unity, Netflix, Dow, and Dow is, I think, shown here just for the comparison, because Dow did not drop that much. So if you look at these, like even this high quality company, which is like the hero of the last decade, is down 75%. Unity is, I think it is down further. Some, when they took this, I think probably it was 50, now it is lower. This Upstart. So some of these companies are almost like fraud companies. Like they did very big mistakes that was like, when they were doing that mistake, we should be exiting those. Like if any company does very big acquisition, at very lofty valuation, like that is not good, because acquisition, there is very high chance they don't work out 80% of the time. Only 20% of the time acquisitions are successful. And so acquiring a company and making it work is not easy. And then if you do that at very, very high price, then definitely it will put a lot of pressure on your balance sheet. So this company acquired another company which was making only 90 million on sales, and they acquired in 18 billion. So they got almost 200x of sales for that acquisition. And that is like very big, very big, very big hole on the company. I don't think this company will survive. So a lot of companies here I can see they would be okay, but significant, like most of these I can see which can survive. So like this shop will survive, let's say Netflix will survive, right? And then probably this one, Roku. Rivian is a truck company. I don't think it will come back. So some of these companies will merge with other companies because they have genuine business. Just they were having very lofty valuations, and if they cannot keep up, then what will happen? Somebody will go and buy them at cheaper price. So that is what I can see from the. Well, I have not studied all of them very carefully, but whichever numbers I have looked at and what they are doing, I see like only couple of these will survive. And that is exactly what happened in .com. Like today, like 5-6 company, only few are, those are just those are the survivors. Rest all are gone. They are all finished. Okay, so now where are we now? So this is the chart. It was done in 1995 by S&P. So don't look at a lot in detail, but we have to try to understand the correlation of economy and the stock market. Okay. So if you see, the yellow curve is economy and blue is a stock market. Okay. So if you look at here, that the stock market is ahead of the economy, right? So when economy is peaking, the stock market peaks a little bit ahead of that, right? So what today's stock market is telling, that right now where we are on the stock market, probably we are somewhere here. So, right, because we are like, this is the peak, and let's say that total drawdown would be 50%. So we are already at 35% somewhere here. So if you look at, then the economy, in economic indicators, if you look at, they are already coming off peak. So like GDP numbers are coming a little lower. So some may be peaking out, some may be already peaked. There's your inflation number is already peaked. Probably now slowly job market numbers will also start peaking. So what happens that when economy just keep coming down, and then this is your, if we are here, then we will still go down a little bit. And then when this economy will bottom, market will bottom before that. So when the economy bottoms, market will bottom before that. So this is all considering that probably this thing is in play, right? I may be totally wrong. This may be not in play, right? This may not be happening at all, right? So if that is the case, then what will happen? The market will, right now where we are at the bottom, and the market will just go and pick here. And the economy will continue to, like, this curve would become longer. But if economy has already peaked, then a stock market is expected to come down further. And this I'm talking more about in US perspective, because US market, the tech market was only in the big froth. Rest of the markets were okay. So we may still go down, and especially on the tech. And when inflation is very high, let's say inflation, so look at this, let's say we are here, and then let's say that the inflation number starts coming down, right? But you still have from here to here, when the number reaches like a little bit in moderate level, so you still have some time. And until then, the inflation will start doing it, what it does very well. It kills a lot of things. So that is where we see the problem, that probably market will start coming down and economic indicator will start worsening, and then we will bottom before the market, the economy bottoms. So that happens most of the time. And I do not think that we will hit the recession, but moderate economy, it will all depend how the government manages, how the government, it is a lot on the government decision on economy side. And then on this side, definitely, like the way the government is doing the job is I see like very difficult for market to go back to these levels quickly. So probably it will take some time. If it, because if the economy is like on this trajectory, and if there is like sharp cut, then you can go back. But if the economy is following this, then probably you have to, then you will follow this path very likely. And I purposefully took very old because this cycle is true most of the time. Like here, these points which are written, they may not be true exactly now, because from 1995 to now, it is almost 30 years. A lot of things have changed. But like this thing, who is ahead and who is behind, that is very clear, right? So now, if you look at it, where are we now? Relating the key. So okay, so now we relate the what is basically, uh, so we know we are almost here. Let's say in the US market, we are almost here. Economy is on the peak and market is like 30-40% down. The mid cap stocks which have lesser competitive advantage, they are down like, oh man, some of my stocks are down like 90%. So, and so it's like that may be the case. So, and it always happens, the stronger guys are a little bit, they sustain their value, their prices better than a smaller guys. So we are here. So economy, if economy goes down, then we are heading for lower market now, right? So why it is happening? Why the market is basically does it before, right? Because market anticipate this. Okay, so if there is free money, that basically brings a lot of inflation, right? Because a lot of like the quantity of goods is limited and a lot of free money is there, so people just want to buy those things from their money. Then higher, so now when the inflation goes up, and the government job is basically to control inflation, right? So inflation is just like a termite, and no governments want very high inflation. So to control, what do? They tighten the free money supply. So how do we tighten? Is they increase the interest rate. So if they increase the interest rate, what will happen? Like if you have car EMI, you have house EMI, and then if you start paying more money there, then you have less money to spend for your tourism and for your food and other things. So that is where it is basically reducing the inflation. And then the other thing, what happens, the new decision which we are making would be difficult. Like if I have a income of 100,000, let's say that if the interest rate is 2%, I can afford a, let's say, $1 million house. But if the income remains almost similar, and the interest rate from 2% goes to 6% for house, I may not be able to afford $1 million house. I may be able to afford only $500,000 house. Or I may have to push my decision to buy the house, because I may not able to basically do the servicing of the EMI. And at the same time, there may be a lot of houses which go bankrupt, which go basically for foreclosure, because they cannot service their loan. Like in 2009, there were a lot of houses which went through foreclosure, because they were bought when the interest rate was very low, and the down payment for the house required was $0. Like there were people who just paid $500 and bought a $1 million house. So that is where the decision was made. And then when these things change, then a lot of people have to sell their house. So a lot of houses come in the market, and then it starts basically creating issues with the economies, and then it reduces inflation, but it is a painful time actually. So now a stock price, if you see, so now interest rate went up, but if you look at what happens if the interest rate go up, what impact, what does, how does it impact our stock price? The stock price is basically it is what, two factors multiplied, right? PE, price to earning ratio, and earnings. So PE's drop, this is the impact of interest rate. PE drop when the interest rates are higher. And why the PE drop? Because when the because there are other avenues basically for you to put your money. So if I have 100,000, and if the interest rate are only 0%, or maybe I think here in Canada I'm getting like 0.1 or 0.2% in my bank deposit, right? When the interest rate is 0, I'm getting 0.1. But let's say this, when this interest goes to, let's say 4%, my bank will give me 3%, right? So if I get 3% in there, some people will consider to go and get that 3%, right? In India, like if a lot of money is coming in the stock market, because now people who used to get 9% are getting now 4.5%. So they are withdrawing that money and putting in the stock market. So this thing can reverse. So stocks become cheaper. So that is the reason when it was zero money, people were saying for S&P to be at 25 P is okay, because it is 0% money. So because there is nothing to compete with, so basically this money, the investor has only one asset class, let's say, or like means like the likely place to invest is a stock market, because the fixed income is not working at all for them. So that becomes expensive. And what impacts it has on earnings? So P drops, very clear. Now earnings is the different thing, is it can be either way. So earnings go up generally. In inflationary environment is much better for companies earning. So if I think for us, we are not very like, we are like, how many, like most of us would have seen in India, the people who are from like we are all are from India, like, so the inflation we have seen like from 12 to 15%. And those days, like this Kisan Vikas Patra or all these government securities, they used to give you like 12 to 15% interest rate, and yet a stock market was making more money. And because of this 15% inflation plus the GDP growth, like most of these companies were easily doing 30% growth on their earnings. So earnings grow in the inflationary environment, but the balance should remain healthy. So a stock market would be still the place to be in, right? Because the PE will drop, but the earning will go up. So let's say the PE drops from 25 to, let's say, 18, right? So it is like 25%, 30% drop in the PE. But if the earning continue to 30, 35%, then you still continue to make money there, right? But the bad thing can happen, that if inflation number remain high for a long time and interest rates are raised significantly, right, then the economy can get killed. And if the economy can get killed, then what will happen? The interest and the inflation numbers will drop very fast, but the economy may not recover as fast. So that environment, it is very bad, and it has happened one time in 40 years ago. So in late 70s and early 80s, when the interest rates were increased so much, like 17% in US. Interest rate went 17%. Um, and it basically killed the economy. And if like how many of us remember now that in 2000s or early 2000, even when we were around, the normal interest to buy a house used to be like 5%. Now people have just forgotten it. They don't even know that, oh, in US, the like buying the house was a big thing. Even in US, you talk to anybody who is like 15, 20 years older than you, when they got the job and when they bought the house, it was like almost 10 years. And even in 10 years, if people can do that, is like a good deal. But now we get the job and within 6 months we buy house, right? Because the interest rate is so low. So that is where we have to be like like we cannot underestimate that how much inflation can rise and how much interest rate can go up. So that is a very very bad scenario to be in, and we have to be prepared. Like even for me, if interest rate goes up like 6 to even 6%, I would have a lot of difficulty in servicing my mortgages, right? So it's like it is same for a lot of people. Like I'm a very careful spender and I can have problem. So imagine like the people who are not careful spenders, especially in North America, how much problem they can have. And on the other side, that you cannot hope a lot from Biden administration. They are not very good at basically fixing the economy. So this scenario is quite likely actually. Like I would say at least 10-15% likelihood is there for this to happen. So what can we do now? And I'm saying it is more applicable to US market because a lot of funny things are happening in US market which probably are not happening in India. And so the people who are invested in India, I think that you can just get ready for the shock, but not a lot basically impact from this. So what we have to do, basically look at what asset class we want to be in now, because in the new scenario, you want to get out of the stocks or you want to still, like if you have a better asset class, like if somebody is having like some place where he can get better returns of like 5-6%, it's a good place to be, to just switch and go there, right? But if you still want to be in a stocks, like I would do, because that is the only asset class I know. So I would be stay in stocks. So what we have to do, we have to ensure that each company we own is financially very very strong, right? That is very 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 important in this environment. So if your company is not financially strong, this is the time they will be just wiped out. Now in next 1 year or 2 year, you will see a lot of startups will wind up because these startups are not strong financially, and they've just popped up because some people were working from home and they just wanted to do something and money was available. Now and then most of these startups were basically supported by venture capitalists. Now when the venture capitalists will start going bankrupt, which is happening right now, a lot of companies are under pressure. Like you can imagine that the KKR kind of company, which is such a big investment PPE investment firm, that does only 45 that is only available for 45 billion market cap. The cheapest companies in US right now are PE firms. So a lot of people are anticipating that these kind of companies will be under a lot of pressure now, and that will lead to a lot of startups closing down. SPACs are already out of the game. I don't know. Nobody talks about SPACs. I don't know where those SPACs are. Are they doing something or not? So these SPACs will also not do anything. So because like there is classic signs of financial weakness, right? So ensuring the company financially strong is very, very important. Uh, is the best way is look at how much debt they have, how much free cash flow they generate, and basically zero debt companies are the best companies, right? Because if you have debt and your interest cost itself will start eating in your earnings. Because right now, let's say I have $1 billion debt and I am paying only 2 million in interest rate, or maybe maybe 5 million in interest rate, and that becomes like 50 million. So that will eat away and make my earning negative, right? So that it's better to have the companies which has zero debt now. So which especially, so that is where in US there is some respite uh, in comparison to 1999, that the biggest companies like which are like 20% of the tech are Apple, Microsoft, Google, Amazon, and Nvidia, I think, right? So these companies are almost debt free, and they are financially very solid, and they are generating significant cash, right? So where in 1999 the market leader also were not solid. Like even Microsoft, the biggest company, was at $600 billion, and it was doing only 10 billion in sales, right? So they were not financially solid. They were just on. So that is why they were, like, people used to call that it is just paper money, right? So, but now our bigger companies are very solid. So it is better, like when we have mid cap or a smaller companies, very ensure very, very well that they will survive, because they don't have debt issue, and they are generating good cash. If not, go in these larger companies, right? So they do not like all these bigger companies. Yeah, so this is the biggest advantage, the biggest thing we need to take care in inflationary environment, that the company should have huge capital advantage, like should be able to pass the cost increase to the consumer. Otherwise it creates a lot of pressure to the in the company's earnings. So like if the company cannot pass the cost increase to the consumer, it has to bear it, and that is not good. So either their sale goes away, or their earnings goes away. Both are not good. So competitive advantage assessment is very, very important. Like you have to see, okay, so let's say that I have this company, and if it increases its price by let's say 10%, will I still buy that product or not? We got to be in those kind of companies, right? Like for example, Netflix, right? If Netflix charges me $10, I'm okay. But if tomorrow he says, okay, now the new price is 19.99, will I be okay? I don't think I will be okay. But if Microsoft says that, okay, your Word license is expiring and new price is 19.99, new prices increase from 19.99 to 199, I have no option, because that is where I work, right? So I like they can pass on their cost increase very quickly. So like these kind of thing we have to see very well in, and especially in mid cap a lot, because most of this mid cap and a small cap, either they will be gone totally, or they will be bought over by other company, or they would be merged with other companies, and in all probably there would be price destruction for us if we are shareholders. Because When the economy is bad, what happens that even when they are merged with other companies, they may not get very good price. So you have to settle with that price, right? Like a lot of people bought Twitter at $80, and the new price is at 54, and even now the deal is put on hold. So we don't know what the new price would be further. So even when the company is bought over by another company, the people who bought at $80 are still losing money, right? So that is where we have to be very careful here, that make sure each and everything has this called, what can we say, competitive advantage. Then search, and it doesn't need capital to grow or maintain the business. Then we need to search for the recession proof companies. So the companies which can do well even in recession time, right? Those companies we have to do, search for it. Like I would say Microsoft would be one of those, and then probably Amazon is also, because what Amazon and Walmart do in recession time, they are useful because most of the time their price is very competitive. So a lot of people like search for low price options, so they go there. So that is why it is called recession proof. Cigarette companies, right? So during no matter how much recession comes, smoker needs cigarette, right? So those are recession proof companies. So yeah, search for those options. Those are good. And here I would say that the people who are invested in ETFs. So now you see what is the problem with ETF, right? So the problem, I do not invest in ETFs. You know why? Because the ETFs are basically slave to what is happening. Where if you don't invest in ETF, like take that ETF and just take top five companies on that ETF and just buy those five stock, make it a basket of five, and just invest in those five companies, right? It is very likely you will do better than ETF, and you have more control, because out of these five companies, if let's say one is like suddenly you sense that Facebook is very lofty valuation, probably when the result come they won't do well, you exit the Facebook or you reduce the Facebook, and then switch to some other thing. And then if the Facebook basically goes down to like 50%, like it was happening, then you have advantage to basically take some Facebook, right? So making a basket is much better than doing the ETF, because now ETFs, when the market goes down, they for sure are going to go down. There is no respite there. So then you have to just wave the ride. But only thing in ETF, there is protection that, okay, they will not go down to zero, because there are bunch of companies, and even if like a 10%, 20% of the companies are gone, still 80% companies are still there. They will hold the price. So that is the ETF thing. So I would say that instead of ETF, if you have a ETF, look at the ETF, see the composition of it, and then look at the top 5 6 companies, buy those companies separately, and then increase your chance of overperforming. So that is and yeah, reduce expectation of returns. So if some people made a lot of money in last 2 years, I don't think you can do that now, right? So now it is better to go and buy Berkshire Hathaway or or Costco or something, right? Because those kind of companies which were not making a lot of money for people, they will still stay the keep their price probably, and you will lose a little lesser. Yeah, that's all I have. So yeah, we can go for question.
Hi, Manish. Can you hear me?
Yeah, I can hear you.
All right. Yeah. Thanks, Manish, for a very excellent session. Uh, I can't stop talking about how good, how useful was it for me. But anyway, I'll give my compliments later. We can still listen to people who has questions.
Yeah.
Raja, you have some question, you can ask directly.
Yeah, I think in chat box somebody put question. Yeah, yeah, is yeah. Raja's question is Netflix, right?
Yes, sir.
Yeah, I believe that Netflix doesn't have has competitive advantage because if you see, like, Netflix was more than $200 billion company, and they have this app, and then they have a lot of content, right? And initially, and like they grew their earning because their consumer base was growing, and it was thought that the if you have an app that is like very scalable, and you can do a lot of you can just continue to increase your market share and continue to basically offloading content to the people, and the number of subscriber will continue to grow. So that became a $200 billion business. But now imagine, in India you have Woot, you have Z5, you have Sony Live, and if you look at their content, is nothing basically lower quality than these guys. Like Sony Live, any web series you watch, they're almost as good quality as whatever you see in Netflix, right? So in, in India you can get the whole Z company for less than $8 billion, and they have Sony Live, Z5 now combined. They have so many channels, and they have so many movie productions also. So, so why Netflix is $200 billion? I don't know. Is I feel they don't make a lot of money too. So no, I was more surprised when Netflix was 200 billion, and now I think it may be 100 billion, or so, or maybe 50 billion, wherever it is. I believe they can still go down because, or even if they don't go down, they will have a lot of pressure to basically keep up with their with their share price. So their share price would be a lot in under pressure. So I think there are much better opportunities. Still, like if you see Amazon has already Amazon Prime, which is basically not only Netflix but also a subscription. So, and that is already in Amazon in $1 trillion. You have Amazon Prime, which is equal to Netflix. You have logistic company, which is like 3 or 4 times bigger than FedEx. Then you have 40% market share in AWS, which is cloud. That is very big business. It generates like 40 billion cash for them, right? And then you have e-commerce company, which is almost like 500 to 500 billion plus business, because they are the market leader with 30% market share in the US. So, so it's like it seems like Amazon is much better deal, right? Yeah. Anybody else? Yeah, please feel free to ask question, make it discussion. And today we are very few people, like, so it is good. Uh, yeah, one more question. Yeah. So Kunal's question is, why is gold or silver not making a move during these uncertain times when most asset classes are taking a dip and USD is rising? Yeah, that is what I think. I'm a little surprised that gold is not moving up, because in uncertain time, gold is the one which moves up. And basically, like even in so now if you look at it, in 1999, gold did not go that much. But if you see in 2009, gold moved from like 400 $500 to almost $2,000, like 1,800 or $1,900 it reached. So in 2009 crisis. So the reason, probably it is happening because it is like a lot of companies are still available maybe, and the gold will not produce anything in inflation times, so that they know. And it is very tech specific bubble, so that may be the reason. And then in 2009, what was different, it was financial crisis. So now suddenly, like a lot of people lost trust in let's say bond, and and then the stock market was already going down, so some people parked their money in gold. So that is why the gold price popped so fast and so much. And gold was already in bear market for many years, like 20 30, I think 30 years, like from 1981 peak, they took out that peak in 2009. So that is where the difference was in gold, in that crisis and this crisis. I think even in COVID, gold did not go down, go up a lot. So it is just what alternatives are available. Yeah. So one question is US dollar and rupee. So rupee and US dollar is different than others. So right now, US dollar is strengthening. It is getting stronger. And rupee was with the new government in India, like I think they are maintaining a policy 2 to 3% decline every year, and basically let rupee depreciate by 2 to 3%. So they want to control it, not make it a lot like not basically just letting it go haywire. So now it is happening that US dollar is getting very, very strong now. And when US dollar is getting strong, then what happens that rupee was ideally rupee should cross 80, but it seems now RBI is intervening and basically selling whatever US dollar they have and trying to protect it at somewhere around 77 78. So probably that is where they will stay, right? And will the Russian sanction affect the USD? Yeah, in long term, USD is in not good shape, because if Russian sanction happen, and what US did to Russia was not good for US itself, because the trust in US dollar will go down. So Russia, US limited the access of Russia to US dollars. So now let's say that as a country, uh, I am holding 1 trillion of US dollar, and I know if I do anything against US will just basically restrict my sanctions. That means it is equivalent to I lose US dollar, because I cannot do anything of it. So a lot of companies, a lot of countries which are maintaining these things, which are maintaining these reserves, those countries will be basically start thinking, and they will diversify their reserves. Right now, most of the companies are 70 80% in US dollar, and like India has only like 5 or 6% in gold, and then they have some other things in their reserves, but US dollar is very big junk, so they would reduce the US dollar, and then they will try to have other currencies in there. And then other thing will happen, a lot of countries will start trading in their own currencies. So but those things take a lot of time, like it will take like 10 years. maybe to show something. Yeah. Okay. Yeah, I think it is. Yeah, today I think we are not doing that bad on time.
Yeah, that's good, Manish. Manish, actually, small question. So this still stocks are going down, down, down. So still we can expect a few more days or months this one to going down, or shall we pick a few stocks now? Is the correct time, or still can we wait some more time
No, yeah,
to pick the stocks, to buy
so,
the
so
stocks?
so I think if you want to pick the stock, you have to look at the stock what it is doing, right? So if I have, like, if I have to pick the stock, some stocks are already at bottom, right? They are making new bottom every day, right? So what I do in this scenario, I if I ensure that the company will not go down, what do? I create like a kind of buying dip strategy, that if if the stock goes down 20%, I buy, then it goes down further 20%, I buy, right? And until I have a number in my mind that how much I want to buy. So not more than 10%, right? So I create, uh, let's say that I create semicon basket, right? And I said that, okay, I will have 20% in my semicon basket. So I want Nvidia in my basket, and I think Nvidia is expensive right now. Let's say it was at that time, it was $195, let's say, or I think 180, 191 or 185, something like that. So I bought only, let's say, one. Nvidia is ideally can go up to 5%, because it is total is 20, and out of four stock, one is Nvidia. So let's say Nvidia can maximum go 5. I will buy just 0.5% Nvidia. When it goes down, I will make it 1.5%, then 2%, then 3. So I will, when I will start approaching the limit, then I have to see that do I increase it, because let's say today Nvidia goes down to, let's say, $100, it is a screaming buy, because this company will not go bankrupt. It has very high cost advantage, and it is gaining market share. It is the biggest graphic company, and it is has big role in video game industry, which is going to increase. Video game industry is not going to decrease. It has a very high growth rate, right? So Nvidia is a very super play for that. So that is where I would basically that is how I play, that when it goes down, I buy more and more. So for individual stock, you have that advantage, because some of these stock will bottom out, and they will not go back. It is very difficult to see that that okay, so now this stock will be basically is basically if market goes down, the stock will go further down. It's not necessary. So some stocks bottom earlier, some bottom late, and some may not even go down. Like for example, I don't see 3M going down at all. So that is where we see, like, unless there is a very big need to basically uh, like venture into tech stock, what is the need? Just go and buy Berkshire Hathaway or 3M or Costco. There are a lot of companies which are there. So if you have to buy, if you really have to buy, because these company can still make money right now, right? And the tech can further go down. So tech will further go down. These company will go down much lesser than tech, and they will still stay because they did not go up. Like Berkshire Hathaway is trading at like 7 PE or something, and on the book value basis, they are very cheap. They are like at historical cheap. So yeah, I think that would be my strategy.
Yeah, I was looking at these ones dropping, but yesterday surprisingly market was a little bit better, almost 5 to 10% all stocks is rising. So I am thinking, oh, maybe we are missing, or maybe that is one day temporary, but yeah.
Mm.
So sometimes
Yeah.
it's confusing. Yeah.
Yeah, yes. So we have to basically look at what happened in previous bear markets. All right. If you look at the previous bear markets, you will often get rallies, often get a big moves, big rally, and then again it dips. So that is where we have to see, do we think it is a bear market or not? If it is a bear market, bear markets are quite long. They take time in bottoming. So I would say if it is bear market, you have easily 6 months to 1 year to buy a lot of things. And these things can go surprising so cheap that you cannot imagine. I remember I've seen full cycle of 2008 bear market, and at that time I was not in too much in US market, but in Indian market, like even in US market, Dow Chemicals dropped from $60 to $6, right? And because they made a acquisition of Roman Haas, and there they had some difficulty in finance available attaining the loan for that, and they back out the deal, and that is where some people thought this Dow will go bankrupt, and it made like 5.6 was the bottom, and that bottom was made much so like when it made bottom of 5.6, within a week it was up to $16. So from 5 point so from 60 to $56 to $5.6, and then from 5.6 to 16, everything happened in very short period of time. So if those and now at that time, if you see that somebody say, okay, no, Dow will not go bankrupt and I will buy it now. For that you need to have a lot of research on Dow Chemical kind of company. Then
That
Warren
decision is very critical. We take. Yeah.
yeah, it is very difficult to make that decision.
Yeah.
So that is where that is why always have less number of a stock. When you have total grasp on them, those, then you have more stocks, so that like in my view, like if I own any stock, I think that I have a responsibility to know the stock more than any commentator on TV, right? I should know more than him. I should remember the numbers also. I should remember what he said and what he did, all those things. Yeah.
Great. Thank you, Manish. Yeah.
Kunal's question is, what risk management strategies should one consider if we still want to stay in a stock market? Do option strategies work? Yeah, I think option strategies may work, but I have not used it. So for me, is very interesting. Like I have tried doing trading 2-3 times, and every time I have lose money. And the reason is what I feel, that whenever we are doing trading, if we are not able to give time 100% of the time, it is very difficult to make money. Like it is not like a buy and forget kind of a story. So I think Shiva is options expert. Shiva can tell.
Yes, Manish, I can add something to Kunal. Yeah, Kunal, thanks for really bringing up this topic. So most likely for this type of environment, certainly option strategies can work, provided, like Manish mentioned, you should have right time invested in that, because you need some time to closely monitor, and you can do. So one quick option strategy I would recommend for this type of scenarios is, the baseline is like what Manish mentioned. Don't go for companies which you don't have conviction that it is a strong company, right? That is given. That is a boundary. Don't play with any funny stocks, right? Whatever I'm going to say. Assume that, for example, if you think that Microsoft is the right company to hold at this moment, and Chevron, for example. So these type of whatever the companies you think that they are going to do good at least protect your principal, select those companies in your portfolio, and whatever the amount of stocks you have, you can short call options, slightly out of the money, and whatever the companies which you think that you want to buy more, for instance, a company is now trading at $100 per share, and you think that it is still worth to, or you are willing to buy at $90 per share, you just sell the put option of 90 and just wait for it, right? If it happens, if it goes less than 90, just take the delivery. If it doesn't go, just keep that options premium. Similarly, whatever you think that you already are sitting on profit and you are okay and you have some alternatives, you just start selling call options at slightly out of the money. So by regularly doing this, you can generate regular cash flow. I mean, of course, this was the key topic which I covered in last one session. Exactly, timing. Timely session for the upcoming market trend, which we don't know, right? So you can take a look at that recording and we can still post if you have some questions. But the key points is the boundary is what Manish mentioned, right? Pick the right stocks. Second key point is sell the calls only if you have the underlying companies, the stocks, and sell puts only if you have the cash to take the delivery. If you are a genuine buyer of that stock and you are willing to buy one more lot of the stock, then just sell the puts. By continuously, regularly selling calls and puts within these boundaries, the next 2 or 3 years, even it's going to be regardless of bearish market or it's going to be sideway market, this is going to really save you a lot of, it's going to protect your principal as well as it's going to boost your returns. I hope it gives some clarity.
Yeah, no, thanks for that, Shiva. Hopefully you can hear me.
Yeah, we can hear you.
Yeah, I can hear you.
Okay, great. Yeah, thank you so much. Yeah. If you don't mind, maybe sharing the link to that video, that'll be great.
Yeah, sure. I think you guys are new to Valam group, right? You are not in that group yet, right?
Yeah. Kunal is.
Yeah, I will add that group and I will provide the links for all the previous sessions, and you can find that specific options trading sessions in the link.
Thank you, Shiva.
Wonderful. Yeah, and another question is, do you do valuation based on DCF model or have a different approach? Yeah, I use DCF model definitely, because DCF is the key to understand basically, because it clearly tells that the $10, what the value it holds today is not the same. It is 10 years later, right? So that is where I use that, because see, when we value the stock, the valuation based of the past is very easy thing to do, right? But and a lot of people can do, but valuing the company where it would be 10 years later is very, very important. So first step is value what is company now. Second step is where the company would be 10 years later, right? And now you see, okay, so this is the current price. So how much I am like, so let's say that company is doing $1 billion on sales, let's say today, and I expect that, like, I do my evaluation and say that 10 years later the company will do $5 billion sales, right? So now I cannot multiply same sales rate, P to sale, price to sales currently, because when the company grows big, the price to sales often will come down. So I do that adjustment, and then I can say, okay, so probably the share price for this would be 10 years later would be this much. So if let's say today it is 100, then 10 years later, if it is coming $1,000, then I can say, okay, so it makes sense because it is 26% return, right? So, so now 26% return makes sense for me or not? That I have to decide. For me, it makes sense. 10 years later, 26%. I do invest in some companies where I see, okay, in 3 years, probably they will double. So that is also a good ratio for me. Okay, so in 3 years it doubles, that is fine. So it is like the discounted cash flow model we have to basically do in when we are comparing the dividend stocks versus no dividend stock. So if you look at it, you would be very surprised if there is a company which does 5% dividend, and let's say even if it is if the stocks remain flat for 10 years, it will make a lot more money than the company which doubled in 10 years, right? And that is with discounted flow model, that is much better deal because dividend is coming just it is coming now, it is coming next year, then in the coming next year, where the price increase is like when you sell 10 years later the stock, you will get that time. So that if you discount today, it is very small. So that works when I think discounted model helps me in evaluating those opportunities where there is a regular money coming back to me, and versus where I have to just buy today and sell 10 years later.
That makes sense. Thank you, Manish.
Yeah, is it right time to buy SDFC bank share? Yeah, I think it's perfect time to buy SDFC. SDFC and SDFC bank, both I have both actually, because I think it is the SDFC is no doubt will become the biggest bank in the world and by next 5-6 years maybe. And now with SDFC merged, like they will have, there is nothing on earth they will not own. They will have SDFC life insurance, SDFC AMC, SDFC lending business. Then they have education loan business. They have, I don't know, there is nothing on in this earth on the lending business which they don't have. And SDFC is, I think, the best company probably by corporate governance. So I don't think there would be anything wrong. And the price has surprisingly come down so much where there was clear opportunity. Right, I do not know why the price is coming down. So this price coming down for SDFC, I'm very surprised. Either I am missing something, I don't know. What I feel that there were a lot of people who did not own SDFC, especially institutional investor, and so those people probably want to buy, and basically they are creating some kind of rumors or something in the market, and some people are selling. I do not know what is the reason for. Some people are saying that that there is a limit to what they can hold, and for that to bring it the mutual funds kind of thing, they have a limit on maximum how much they can hold, and when they are merged, then that limit will be crossed, and that's why they have to force sell. I doubt that, because when you merge, then the new shares are created, so the percentage limits don't change. Yeah. Yeah, Yes Bank basically I don't like them. Yeah, it's anybody who has corporate governance issue is very difficult to understand that they will change themselves. I already tried in couple of times and I failed because the management's promoters who have corporate governance issue, they continue to have corporate governance issue. They just say that they change themselves, but they don't change. So, but here I think there is takeover by SBI, and I think probably it is in better hands, but we do not know that the culture has changed or not. And especially in banks, there is so much opportunity. So many great banks are very cheap. Like if you go and see Karnataka Bank, is like it's crazy. It is like 0.1 time of book or 0.2 times of book it is selling. where so like book value for Karnataka Bank is 300 plus, and it is selling for 60 rupees, and it is a private bank. It is growing very fast, right? And it is growing in basically corporate in consumer market too. And it is not held by promoters. It is mainly, it is run by basically professionals. So promoter holding is not there. So that is why I consider it a good thing, basically, because it brings more professionalism in how the bank runs. Similarly, you can find many banks, like even in private, you can find the banks like Karnataka Bank is a private bank, and it is so cheap. So with Karnataka Bank, I have much more surety that if it like all other private banks which are trading at 2-3 times book, if it also reaches even 1.5 or 2 times book, it is a multi-bagger actually, right? So why will I go and look at Yes Bank? Oh. Yeah. Any other questions? If no, then yeah, we can save time. It is 1.5 hours now.
Yeah, Manish. I really thank you for your time and the efforts you put and your passion to share your knowledge with others. It's not easy to really share all your uh, all your experience and your thoughts with others. So it's really personally, I felt that I can connect the dots from my interpretation, what I'm seeing in the market, and how I learn from this type of scenarios happening now, and how people like Manish is viewing this, right? So it's a lot of learning. It's really worth to watch this video again and refresh ourselves. On behalf of the whole Valam team, I'm really thank everyone for supporting this type of events, and for the contributors like Manish, who regularly put efforts and time to really share his knowledge and
Yeah.
wise.
Yeah, happy to learn with you guys. No problem.
Right.
Yeah.
So
like
Manish,
yeah.
one request is whoever wants to join the Valam group, please pass me the numbers to me so that I can add and let them have that link to the previous recordings.
Sure. Yeah. So Kunal is the one, and Mohit is my classmate. He's from Delhi. So I will send his contact to you. You can join in.
Okay. All right.
Yeah.
Thanks, everyone.
Yeah.
Thank you very much, Manish. Yeah, your presentations are really grateful, particularly for me. Likely, just I am a recently I came into this stock market, and I think I am the big loser compared to all colleagues on the screen right now. But luckily, Manish came to Canada from US. I feel sometimes I like he came to save me. It's a very big money without getting understanding. I put lot of money, and I lost more than 50% so far. So now Manish is guiding me to recover little bit. Maybe I can say 90 lakhs. I put it right now. I am at 45 or 50 lakhs. So I don't know. Yeah. So we'll see what will happen. But still, I am hoping good things to be happen. And yes, always I am disturbing Manish, and he's giving me some guidance. What is the cutoffs we need to do, and what we need to increase the portfolio, something. So yeah, if something goes wrong, I spend 10, 15 years in Canada to earn the money. And if something goes wrong, the all 15 years life will be just in the dump. Yeah? So yeah, we have to be very careful. And my mistakes I did, and without getting knowledge and which company we need to select, I dependent on the advertisement stocks mainly, and I put it, and that's what happened. Why I am sharing this experience, you guys, the loss is So everyone's experience we have to count. So maybe if it is useful for you guys, but you are experienced. So actually, I brought all the stocks when the market was like a June, July last year when it was peak. For example, Unity software stocks, it was 160. I brought it. Right now is $35. 160 to 35, it's a drop. Just before a few days ago, Manish told me, hey, when it is 50, sold out. I sold it and it's dropped to 30 again. So yeah, sometimes always the guidance is required, and it's a day-to-day learning. Whatever we know, still we need to spend some time on learning. And thank you very much, Manish and other team guys, for great knowledge, and happy to join with you guys.
Yeah, no problem. Happy to be of use to any of you. Anybody can give me call, and we can talk and discuss. And it is not like basically I know anything, but what I do that like I just try to stay away what I don't know. That's it, right? Nobody knows. We just talk like even Unity, it can go down to back to 100 again, but I have to stick with my principles, let's say, right? If the company is not making money and what it is doing, right? It's like if company is not giving dividend, it's fine with me, but at least company has to make money for itself, right? So those are very important parameters, and a lot of people can do trading based on the indicators and all. Well, I'm not good at it, so that is where I stick to those principles, and ultimately they play out. Like T-Doc, the day I looked at it, it was $90, and I say, oh, it's fraud company, and then now I don't know where they are at, like 30 or something. Yeah, so we got to check that, and slowly our accuracy of finding these things will improve. If you see in India, I am following the market. There are so many fraud companies we have seen, and none of these fraud company you will see Rakesh Jhunjhunwala was there, or Ramesh Damani, or this Sunil Singhania. These guys are not in those companies at all. So somewhere they have the accuracy to see that there was fraud, and they are more accurate than us. So we need to learn that how they do that is like how they can sense the fraud. So like Yes Bank, before the fraud happened, right? I remember that I one of my relative works in Yes Bank, and we were talking to him, and he was saying that Yes Bank is the number one company in whole India. And then I said, no, I think Yes Bank is number 3 or 4. He said, no, in private. I said, yeah, in private, SDFC is number 1, ICICI is number 2, and Yes Bank is after that. I think there was one more
Third is
bank.
Axis. Third is Axis.
Third is Axis,
Third
yeah.
is
And fourth is Yes Bank, yeah. So I told him it is number 4. He said, no, now it is number 1, and something like that. So Yes Bank was basically creating all this persona all around it. So Yes Bank, you will see maximum number of ads when you go from airport to your home or your hotel in any city in India. Yes Bank, you will have highest number of ads in railway station. You'll have find their stickers all around on the chairs, on the walls, and everywhere. Then the and these kind of things they are telling to their employees that they are number 1, right? So all these things are the good indicators to find out there is something fishy going on top of it. Like some of these guys, what do they do? That like this Ramdev Agarwal, he was telling that he sent his one guy to the bank and said, okay, just go and ask for loan, and ask like if I know I cannot get 10 lakh rupees loan, and go and ask for 20 lakh rupees from Yes Bank, and then the guy will say, yeah, I don't think you qualify for it, this thing, and and then offer a bribe, let's say, right? And once you say, okay, I need to talk to the manager, that is a bad indication. Right? That means once you offer the bribe and he is talking to his manager and he's going to give you loan, so that is not a great company. SDFC, you go and try that, it will not happen. So that is called channel check kind of thing. So we need to do a lot of channel check. When this persona is created, you will tend to see that this thing is not that what is the like you will tend to start agreeing with the narrative, right? So like for example, Tesla is the company I was never happy with the valuation, because I thought that Tesla will never fly and this thing and that thing. I was totally against it. And but some people said to me that no, Tesla, if you see, it is like the iPhone. Once you sit in Tesla, you will not like to look at any other company. I said, okay, fine. So I went and booked the test drive with Tesla and went and see. I find Tesla, if you sit in it, it is not as good as my Lexus. It's like it is not any different. Like Lexus is much better when you sit and comfort and all around. Tesla automotive powers are better, like it is a little more automotive. So and like the things which can go on auto is much better, like it can sense the traffic light, it can brake, and it can sense the car lanes. You can see which is on side and all. So those things were much better in Tesla, right? But Tesla was like 2.5 times price so of Lexus for equivalent size car. So I said, okay, so man, that is very expensive. Then I went to Tata Motors, owns JLR, I-Pace. And then I was surprised that I-Pace was even more expensive than Tesla. And I-Pace, the wait time is right now is 14 months, where Tesla was able to give you in 4 months. So all these things helped me understand, and I said, okay, fine. So it seems like Tesla may have some potential, because people are ready to pay so much money and they are ready to deliver, because where other guys are doing chip shortage, this guy is still delivering, right? So I what I found that it was not a bogus company. So I'm telling the opposite side story of Yes Bank, right? Where I was a skeptical, but I found, I think, okay, it is not bogus. All we have to do is look at the valuation and where the valuations are and what price multiples or what value we can give it, right? So, but before that, I thought it is just like a fraud kind of, like not fraud, it like very overhyped kind of company, and probably it is like pumped up by its own people, all this kind of thing I used to think. But now I know that even if it is pumped up, if I can value the company, then I know when it comes to my price, I will take that, right? Okay, wonderful. Yeah, let's catch up later. Thank you, Ram Babu, for your kind words, and thanks Kunal and Mohit and Raja and Siva for joining.
All right. Thanks.
Wonderful.
Thanks, everyone.
Yeah. Thank you very much.
Thank you, Shiva sir. Thank you, Manish sir, for all your support and knowledge sharing for us.
No problem at all. Yeah, thank you.
Thank you.
Bye. Bye.
Thank you, Manish, for the session.